Hello traders, Gary Wagner here. Just about 11:15 in Honolulu, 4:15 in New York. It is Wednesday, December 21st, 2016, and this is the Daily Report for Gold and Silver. The silence is deafening. As we quickly approach the holiday season, we have seen the characteristics of lower volume and compressed range dominate trading activity across the board in multiple markets. Gold closing off fractionally down about 90 cents at 1132.70. But take a look at this range, the low 1131 and the high 1138. We're looking at a $7 or $8 range in gold pricing today, of which there was really only trading activity taking the market up $1 or down $1 throughout the majority of the trading session. Nonetheless, about a 0.1% decline in terms of pricing. Silver futures did not fare as well. Under pressure today, again, off almost 0.75%, closing at $16 per ounce. That's a 11-12 cent drop. In terms of the range, we have seen it trade to a low of 15.95 and a high of 16.24 on the day. So traders, as we get closer and closer to the upcoming Christmas holiday, which occurs in a couple of days, and then next week, the end of our calendar year 2016, and a new year, which will begin, we can expect volume to really reduce substantially. We can expect the range to contract. We could get volatile spikes due to a decrease in liquidity. However, the real question that we need to postulate at this point is whether or not we've seen any kind of technical evidence that a bottom is at hand. And prior to that, have we seen any technical evidence that the market is consolidating? Now, the fact that we're going into a holiday weekend, even if we were to see any kind of consolidation in the market, we would be hard-pressed to understand whether or not that consolidation was an occurrence based on a reduced volume or a key pivot point in which the reins are being moved from the bearish faction to the bullish faction. In other words, that key reversal or pivot point. When we look at the technical levels that the market has traded to this week, we can say that we've had a lower high than the previous week. Now, we're looking at a weekly chart, and you can see this, of course, is a spike that immediately followed the presidential election results, and we have gotten consecutive lower highs week after week for now the last 7 weeks. We have had lower lows for the last 6 of those 7 weeks, as this week, although not complete, is an inside trading week. In other words, the entire range fits into the prior trading range. And the question that we must ask ourselves is, we are quickly approaching our initial target that we felt has a real decent probability of a point in which we will see the conclusion to the selling, which really began in July, took us up till the beginning of October when we had the final spike of the year, and then, of course, the presidential election in which we saw the market trade about $50 higher immediately following the results, only to close substantially lower in the subsequent days, and then, of course, the aftermath that followed. We are living in a risk-on environment. Equities have been moving to new record highs. Safe haven assets have not in any way gotten any kind of limelight since the election last month, and we continue to see downside pressure being prevalent in the market. However, we are now within striking distance, as I said, of numbers that we have been looking at. Now, this is a 78% retracement, comes in at 1113. We also have a 75% retracement, which comes in roughly at 1123, and it is the intra-week low that we achieved last week. Now, the reason that 75 to 78 is such a key level or an important number in terms of the model that I am currently looking at, that is based upon basic Elliott wave math, which states that in a corrective period where you have some sort of an A, a B, and then the final concluding C, that B wave, in terms of a basic model and formula that we as Elliott wave technicians follow, is that the B wave will typically be anywhere between 50 and 75% of the move that transpired in A, which means that we could have looked for something at around 1200, but this market has sold off a lot more intensely than initially perceived. And at this level, 75 to 78 is a key area that, in fact, we should find some technical support. Whether or not that technical support is a slight bounce before heading to lower pricing, or whether it's an actual key pivot point and conclusion of B, is something we won't be able to determine until a price data unfolds going into next year. However, this is the area that we need to look at, and if we get technical confirmation that a bottom is in place and that we've gotten some kind of bounce to the upside, of course, any traders that have been maintaining short positions, you are going to absolutely want to liquidate those positions, and we will look for an entry point. However, until the point in time in which we see some stability in market price, we will maintain our sideline position as our position of record. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another update and review. Bye-bye.